All righty. Thank you so much for joining me for this SchiffGold interview. I'm really excited today. If you've been following SchiffGold news over at schiffgold.com/news, and if you're not, you should be, you will have seen over the last several months, we've added on more data-driven analysis. And today with me, I've got Tony. He's the guy writing that stuff. So we're going to talk a little bit about technical analysis and then maybe dig a little bit into the COMEX, which is an interesting thing that he's been following and writing about. So Tony, thank you so much for taking a little time to join me. How are you today?
Great, great. Yeah, happy to be here. Thank you for inviting me.
Yeah, well, this is great. I've been wanting to do this for a while. You've been writing for this site. I don't know how long it's been, but it really adds a lot, I think, to the analysis that we're doing. So we're really excited to have that content and kind of wanted to give people an idea of kind of what you're doing and how you do it and why it matters. So, but before we get into that, why don't we just talk a little bit, tell me a little bit about your kind of background and how you got into financial analysis to begin with and just kind of where you're coming from.
Yeah, absolutely. So I think for me, it probably started in 2008 with the financial crisis. Prior to that, I was an econ major in college,
Mhm.
and I've followed the stock market and the economy kind of generally as long as I can remember, even well before college. And so, when the financial crisis happened, it caught me by surprise, as long as tons of people in the mainstream media, right?
Right.
And I started trying to look for reasons to try and understand it. I remember in college talking about yield curve inversion and whatnot, but
Mhm.
I didn't think that gave an adequate explanation. And around the same time, in March of 2009, I actually took an internship in London with a global investment bank, and I landed on the trading floor with about 1,000 people, and it actually had been about 2,000 people the year before the crisis hit, and they had really cleaned house, but it
Mhm.
was still a lot of people, a lot of activity. It was exciting to be there, and I was specifically on the stock loan desk, so that's where basically hedge funds will call this desk to borrow securities so that they can sell short those
Mhm.
securities, right? And so I started asking around, talking to people, and there was a lot of literature and whatnot, and it's like, okay, well, Freddie Mac was over leveraged 130 to 1. And, what was going on with Fannie? The banks were not well capitalized. And, you talk to some of the desks, and they were saying how, the collateral, they weren't applying the proper haircuts, and, very, very in the weeds financial jargon. And,
Right.
and, while I understood it, I don't think it would be something easy for me to explain to somebody,
Right.
like a friend that's not in the financial world.
Sure.
Um, so, it wasn't until about a year later, and I was still abroad, and a friend handed me a book earmarked to a specific chapter. And I should mention at the time, in college I did lean more liberal, lean more towards the left, as I think a lot of people do. And then
Sure.
you take some econ courses, you learn about the world, you see the taxes come out of your paycheck, and all of a sudden I kind of found myself in this fiscally conservative, socially liberal mindset,
Mhm.
which really doesn't have a place in US politics.
Right.
And I didn't really feel like I identified with either party. So my friend hands me Atlas Shrugged, and he had earmarked Francisco's "Money is the root of all evil" speech.
Mhm.
And that just resonated. I mean, today, it's still my favorite passage that I've ever read. And I'll read it, once or twice a year. I just really love how well Ayn Rand articulated kind of the hypocrisy of so many people who call money evil.
Yeah.
Um, and anyway, so that kind of opened the door, I think, to some libertarian thinkers. And then you start reading Mises and Hayek
Mhm.
and Rothbard, right? And even modern day economists. Like, I mean, that's when I first heard of Peter Schiff, and I
Right.
read How Economy Grows and Why It Crashes.
Mhm.
And everything started to click into place, right? Where I think before, the analogy I sometimes use is, before scientists put the sun at the center of the solar system, they put the earth there. And they had all these complex equations to explain the planetary movements and, why things move certain ways. And then all of a sudden, you put the sun there, and everything makes sense. It's like
Right.
everything snaps into place, right? And to me, that was what happened, where you put the Federal Reserve at the
Mhm.
center of all of it. And all of a sudden, everything starts to make sense,
Yeah.
right? How interest rates get suppressed, people get over levered into the housing market,
Mhm.
having too many houses, right? And in the mainstream, still today, I mean, people might mention the Fed, but they're never considered the cause of the financial
Right.
crisis.
Right.
Um, So anyway, so I felt like I had figured it out, and it was like gold and silver is a great hedge.
Hmm.
This is late 2010, early 2011, and I started, you know, getting into buying it, thinking I was going to double, triple my money. And you know, I understood what caused it, and therefore I knew how to invest. And again, as anybody knows, then you got several years of a pretty bad bear market.
Right.
Um, and so I found myself in 2015 really confused as to like, what, again, what did I miss? Where are my blind spots? And I challenged myself to really see the other side of the argument. Again, I've been in financial services, you talk to people, and a lot of people, you know, they'll admit, they say, yeah, it's a house of cards, but you got to dance while the music's playing.
Right.
Right. And then there are other people who, you know, take the it's a cleaner shirt and a dirty hamper.
Hmm.
And, you know, I do think there is validity to that argument. I mean, when
Yeah.
you look around the world, Europe is a mess.
Yeah.
China, people don't trust them, right? And when you think about the infrastructure and the liquidity that the US dollar has, you know, there's a case to be made for why it's still standing,
Right.
despite prolific spending by the government and all the interventions by the Federal Reserve. Throw on top of that, I mean, again, despite how badly politicians try and mess everything up, this is still the number one country of innovation, right?
Right.
You think about the last 20, 30 years, the US is still the driving force behind most of the innovation that is happening
Hmm.
today. Um, and so I was reminded of something that is, you know, just because something is inevitable does not make it imminent, right? And
That's a good phrase. Yeah.
yeah, and that kind of resonated with me again, and I said, okay, so I do think the inevitability of the dollar collapse will happen.
Hmm.
Then I started asking when. And you know, with what I did professionally, I did a lot of data analysis in Excel, and then I moved into SQL and some of the programming languages like R and Python. And I said, I can crunch these numbers myself. And so I
Right.
started to go out and gather the data that's available, starting with probably the debt and the US debt specifically,
Mm.
to say, you know, what is the level of interest where that debt spiral starts? Because
Right.
as long as you can make your payments, there's really nothing immediate that's going to happen.
Right.
You know, and doing that analysis showed that, yeah, I mean, back in 2015, 2016, you know, interest on the debt was under $250 billion, which
Hmm.
again is an enormous amount of money, but relative to the entire
Right.
budget, manageable. So I then started to apply that more generally, um, across a lot of data points, and pretty much gathering data from wherever I could, pulling it in with APIs, whether I was reading in Excel sheets or downloading PDFs, and just scraping all that data in, and started just trying to crunch it all. And then I made it available through dashboards. And yeah, and so now I've started to turn what I think are the more interesting data points into periodic articles on
Yeah.
SchiffGold. So sorry, that's my long-winded response for kind of how we got here.
No, that's great. I love hearing people's kind of evolution in terms of their politics and the way they view the world. And it's interesting because I actually came from the right. Um, we kind of ended up in the same place. But interestingly, Atlas Shrugged was also a very pivotal thing for me as a as a conservative who kind of your Rush Limbaugh, um, typical neocon, I guess is what you would call it. I had some good instincts, I think, but reading Atlas Shrugged really started to kind of push me more towards, more of a libertarian a worldview. So it's interesting. It's always interesting to see what people, and like you said, then the next thing you know, you're reading Mises, and then you're a nut, right? So
Exactly.
let's talk a little bit about just kind of generally what you're doing. I like to call it technical analysis, for lack of a better term. That might not be the best term. Um, how do you kind of crunch this data? What's kind of your process? What are you looking at?
Yeah, sure. So, yeah, I mean, technical analysis to me, you know, you could call it that, I guess. I mean, a lot of people in the trading community view technical analysis as charts and,
Yeah.
you know, Fibonacci levels and cup and handle patterns and that kind of stuff.
Yeah.
And to be honest, you know, I don't do a lot of that. I read about it and I see it because I do think there's some self-fulfilling prophecies there.
Hmm.
You know, you'll see technical levels that will be a cap on a price, right? Price will come up, knock against it a couple times, and then all of a sudden, you know, once it breaks through, it really breaks through.
Yeah.
But yeah, the stuff that I'm doing, I think, is more saying, okay, I understand the fundamental picture, but let me get the data behind it and the
Hmm.
analysis behind it. Not to get too into the weeds, but yeah, I use a language called R, and I've pretty much fully automated all the data gathering
Oh,
process.
okay.
So I'm pulling data from probably 20, 25 different places. And I get an email report at the end of the day that says, if any jobs failed, if they do, I go in and tweak it. And it kind of pulls it all down, and I'll do the analysis, on the back end automatically, so that, the next morning I can refresh some of the dashboards that I have and it just automatically pops up. Now, that being said, when I'm writing articles, it's more about telling a story with that data.
Yeah.
Right. So it's trying to identify trends and, more importantly, changes in the trend. And so what I've done, again, even though some of it's automated, the storytelling is more looking at the data and trying to find a different view that says, okay, something might have changed here. Now, when COVID hit, it's like everything started blowing out, right? Like all these trends started changing, and across pretty much all the measures that I was looking at, everything started to kind of go haywire. And so it was very interesting, early in 2020 to kind of watch and follow that data and to kind of see what happened. And yeah, again, I mean, you're talking, deliveries on the COMEX, just to kind of put things in perspective, were 25,000 total contracts in 2018. In 2019, it jumped to about 63,000. And by 2020, that number jumped to 250,000 contracts actually delivered. So, it's just like the change was dramatic. And we can get into kind of some of the inventory, which is one of the more important data points I'm looking at right now. But yeah, I mean, the general idea is you can talk a lot, you can read the news, and you've got all these different people's opinions. But to me, it's when you look at the data, you're going to be able to kind of filter out other people's opinions and really try and get at what's happening.
Yeah. One of the things I really enjoy reading your stuff, because I do tend to look at things more from macro. I'm the guy saying it's inevitable, but as you point out, it's not necessarily imminent. And I find a lot of this stuff that you write really helps kind of fill in some of the blanks. Like, just for instance, you do an article every month on the U.S. debt, how much the debt is expanded, but then you break it down. This is how much of 5-year debt and 10-year debt and 30-year debt, and so you start to see the kind of dynamics within the dynamics. Or looking at like the jobs markets, you look at those trends in the internals, and it really kind of helps. You get the headline. I wrote an article today just about retail sales, and it's kind of funny because when retail sales were going up, that was good news, and now retail sales didn't go up, and that's still good news according to the mainstream spin. You don't really get anything other than punditry. So I really think what you're doing is adding a lot of value to kind of understanding, especially in the more short term, why are some of these things happening today that may seem as outliers. Looking at the gold and silver market, what are just some of the things you mentioned, the COMEX, but what are some other things that you look at in terms of just kind of trying to analyze what's going on with gold and silver?
Yeah, I mean, and again, I kind of look at the market generally because I think, some of the macro trends that you talked about really can drive the market, right? Jobs numbers and CPI data, when that number's coming out, the volatility in gold and silver really start to move. So I think, first, and to mention the debt, right? So, everybody would say, okay, if Fed increases rates 1%, that's an extra $300 billion. And it's like, well, not necessarily, right? And it's not going to happen overnight, because the debt is made up of multiple different maturities, right? And 30-year bonds that are coming off are still at higher rates than the new 30-year bonds are issuing. So in a way, they're still refinancing at a lower rate in 30-year bonds. Now, on the short side of the curve, where the bills are, that's a whole different story. And one of the things that I think right now, there's two really key data points that I'm following. One is that interest on the debt that you mentioned. And if you think about it, right, I mentioned this, but back in 2016, the interest was $250 billion. And in March of 2020, on the first failed Fed rate hiking cycle, it got up to $385 billion. So you're talking about $135 billion more just on interest.
Right.
And then, Fed drops rates to zero, and everything starts kind of moving down. And so by April of the following year, you're only paying $310 billion, which again is still a lot, but it's not going to destroy, that's not where the debt spiral starts, right? But in a year, we're now at 445 billion trailing 12-month interest. Now that's, again, it's not unmanageable, but it's starting to move up, and it's moving up quick. And you got to think that we haven't even really begun to feel the impact of the rates, right? Because it takes about 3 months to really filter through the bills. But then, it can take a year or two to really start to see it in the notes. And so I think that's why the Fed is really hoping this is a quick inflation fight, because they
Yeah.
can't keep rates up this high, or that is when that debt spiral could begin, right? And I think we're going to be seeing 500 billion or more in interest payments by the end of the year.
Yeah. Yeah. It's I keep trying to play out in my head how the Fed's going to play this, because they're still talking tough.
Right.
Um, my gut was that they would, as soon as they got that first sign that CPI was cooling a little bit, that they would try to pivot, and they didn't. But I guess we'll see in September what they really do. But it's you get psychology in play. You can't ever account for psychology. I guess that's why you have to kind of lean on and data as much as you can. But
Right.
I feel like the Fed is a little bit like the bully in the schoolyard. They got to keep their chest puffed up unless somebody sees through the
Right.
through the facade.
It is a lot of tough talk. And I think when the rubber meets the road will be if we are really in a bad recession that they actually have to acknowledge, right? Because they've
Right.
changed the
Yeah. Now
definition,
they
which
can
is
play the
convenient.
pretend. Yeah.
But right now, I think they see inflation because, and again, they need to make this a quick fight, right?
Right.
And that's why I think they're talking so tough because they
Yeah.
can't, I mean, they can't extend this, right? If inflation lasts, I think they're saying what, 2.3% next year. I mean, they are praying that
Right.
inflation gets down that way, that
Yeah.
low, because if it doesn't, and they've got to keep rates elevated for an extended period, I mean, the math is simple, right? This isn't, you know, very complex equations that we have to run. I mean, you look at the balance of the debt, you look at the distribution of what people are holding it, and again, the Treasury knows this too.
Right.
If you look at the maturity, they spent all of last year as the Fed was kind of talking about the idea of raising rates. The Treasury was out there doing everything they could to extend the maturity. They were trying to lock in rates, and you can see it. I mean, they were getting rid of bills as much as they could,
Mm-hmm.
so that if the Fed had to raise rates, they've got a cushion. They've
Yeah.
got at least some window. Because I mean, if they were still sitting there with $5 trillion in bills, I mean, that is debt that's going to turn over quickly at higher
Right.
rates. They cannot handle. So
Yeah.
I definitely think that they are, there is some plan behind all of this. And I think Yellen and Powell work together to make sure that, Powell's like, don't worry, we're going to be raising rates. So she's doing her thing to
Right.
extend maturity. And that way, when they raise rates, it's not that bad. But again, they have a short runway. And if inflation doesn't come down, they're in trouble. And that's why they continue to talk tough, because they
Yeah.
really have to talk it down. If they start hinting at a pivot and then inflation expectations, and then people start to think that they're not going to fight it, things could fall apart. And so they've got to talk as tough as they can. And I think they're willing to have a recession for sure.
Yeah.
If it can mean that it will be a quicker inflation fight.
Right. Peter Schiff calls it open mouth operations.
Yeah. Oh yeah.
They're running their
Absolutely.
mouths trying to cycle. Wait a minute. I thought that the Fed was independent. You're saying that they're like working together with the government? No. one of the silliest myths in all of the financial world is this idea of Fed independence. Anyway, so I want to talk a little bit about the COMEX, because that's something you usually do 2 or 3 articles a month, kind of tracing what's going on with it, and it's been very educational for me. So let's start really basic, because I don't think necessarily everybody knows what is the COMEX.
Yeah, absolutely. So where some of the macro stuff is great to follow, I think you're going to see the movements happen on the COMEX.
Mm-hmm.
And what the COMEX is it's a futures exchange. And go back, however long ago it started, it was a way for people to hedge themselves. So a farmer knows he's going to have to sell wheat, right? He wants to lock in a price. He wants to know what he's going to get for that year, right? He locks in a price because the price can change a lot, right? And if the price collapses and he's got to now sell all this wheat, it changes very much his ability to plan for the future.
Right.
Or think about airlines, right?
Mm-hmm.
They have fuel charges, and so they can hedge their expenses to a certain degree by buying a futures contract. I want to buy this much oil at this price on this date.
Mm-hmm.
And so that is what the COMEX was originally intended for, was for a way for people to kind of hedge risks and plan in the future. Now, what has happened is, this has become a speculator's paradise, right? I mean, you can go in there and take gold, for example. The margin requirements right now are about 3.5%. That means I can put $6,500 down and control 100 ounces of gold, right? And that means I'm getting a 20 to 1 plus exposure to the price movement. Right now, it cuts both ways. It can wipe you out, but it can also allow you to double your money much quicker, right? And so what initially started as kind of a way for people to hedge their risk has become, a much more a busier place, if you will, with a lot more people that are taking bets on both sides, right? You think about negative oil last year, right? Now again, we can get into contango and backwardation and that kind of stuff, but what that was a lot of people were holding oil contracts and they did not want to take delivery, and they were willing to pay you to take oil because they couldn't find a way to store it. Now, something like that's never going to happen in gold, because the storage fees in gold are much lower, and it's much easier to store gold than it is a tanker full of oil. But yeah, so long story short, it's a futures market that has now been kind of was originally intended for just hedging, but has become a broader audience of people participating in the market. And that's also another analysis that I do, is the equipment of traders report. So it shows you all the participants and kind of how they're positioned in the market.
So the COMEX actually has vaults, right? It holds gold and silver.
Correct. Yeah, they have registered vaults, and they print every day. They have the number of vaults, who they are. It's like Brinks, HSBC, JP Morgan, and it will say exactly how many ounces they have. And now there's two types of categories, right? There's registered and there's eligible. Now, let's take a situation, right? Let's say I want to speculate on the price of gold, right? So I'm going to buy a contract for, let's say, December delivery. Now, what'll end up happening is I'm going to hold that pretty much up until the very end, and then I'm going to roll it forward, right? Because I don't actually want to take delivery of the gold, because right now I'm only posting $6,500 per contract. If I want to take delivery, I've got to post the entire $180,000. Right? I don't necessarily want to do that. I want to keep my leverage up. So what ends up happening is that as we get closer to the December contract expiring, I might roll it to March, or well, actually it'd be February or June, right? You have major months, what I call major months, and you have minor months. Now, gold and silver generally alternate months, right? So, for example, August is a major month in gold, and then silver is a major month in silver. And by major, I mean, that's where a lot of the liquidity is. That's where you'll see open interest in gold at 400,000. In a major month, whereas in a minor month, it'll be 5,000. Right. So it's very dramatic and different. But what you also see is that in the minor months, those contract holders are much more likely to take delivery. Right. So whereas in a major month, you might only get 1 or 2% of contract holders taking delivery, you might get 50. We've seen 100%. And then actually something that's been really interesting to follow recently is a lot of people are opening contracts mid-month for immediate delivery. What that means is, let's say that, it's called first notice day. There's 1,000 contracts open. Generally speaking, all of those are going to now stand for delivery. But during the month, you'll see contracts open and people take immediate delivery of it, right? So they're posting the full amount to just take down the metal. And what happens in a delivery is there's a warrant attached to every registered bar. And that warrant, if I'm taking delivery and you're the short seller, then that warrant's going to pass from you to me. But that metal's not actually moving. It's staying in the COMEX vault, and it's simply the ownership is changing from you to me.
Now, one of the things that people talk about a lot, and oftentimes as kind of almost a conspiracy kind of thing, is the fact that there is a lot more contracts out there than there is actual metal, correct?
Absolutely. And that's not a secret. I mean, that is a known fact. I mean, they published that data, but same thing with the bank, right? Everybody knows the bank doesn't have all of our deposits on hand. They have enough what they think is to meet the demands of the customers.
Right. I guess the conspiracy is that we're in there's an imminent risk of we would have called it a bank run back in the day, but a vault run, where all of a sudden you have more people wanting to take delivery of gold or silver even than it actually exists. I guess that's where you kind of find the chatter. And I guess that's feasible, right?
It absolutely is. And Mike, you hit on kind of a point. I mentioned there are two main data points that I'm following right now. And the first one is, like I said, the depth. The second one is not even necessarily the delivery volume, but it's the metal leaving the vault,
Mm-hmm.
right? Because with the delivery volume, a lot of times, like, we can be trading contracts back and forth and the metal never leaves the vault,
Right.
right? But if all of a sudden you start worrying that your bank's not going to have cash on hand, that's when you actually walk down to the bank and you take your money out.
Right.
And if you look at what's been going on right now and you look at the data, the amount of gold leaving the vaults is incredible. Now,
So when
it
you
should be
say
put
that,
in,
that would be like I take I take my bars and I have them delivered to my house and put them in my own vault, right? It's coming out of their system completely.
correct.
Right. Okay.
Yeah. Like, it's not just going from registered to eligible. Eligible means, you're not making it available for delivery. It's yours. It's got your name on it, but it's
Mm-hmm.
still sitting in a COMEX vault.
Right.
I think when it's coming out of the vault, that's when the old adage is, if you don't hold it, you don't own
You
it.
don't
And
own
I
it.
think
Right.
people are taking that to heart right now.
Mm-hmm.
Where they were comfortable, I think, leaving it in the COMEX vaults and just having their name on it. And now you're just seeing, I mean, every day you're seeing just massive withdrawals. And it's really interesting to watch. And I've been waiting for it to slow down, and it hasn't. I mean,
Hmm.
and to put things into context historically, so back pre-COVID, going to your point of the amount of contracts versus available metal, at that point you had, I mean, it was over 100, meaning 100 paper contracts
Mm-hmm.
per ounce of metal that was registered in a COMEX vault. And in September 2019, it saw a full delivery, meaning every single registered ounce was requested for delivery, and they actually had to pull metal out of eligible into registered. Now,
Right.
that's September of 19. That's before COVID hit,
Right.
right? Fast forward to March, and you've got this dislocation between the LBMA, which is the London gold market,
Mm-hmm.
and the COMEX, and the prices are getting completely out of whack. And so the LBMA calls up COMEX and is like, we can help you out, but you've got to change your rules. You've got to make our 400-ounce bars eligible for delivery in your system. And
Mm-hmm.
so obviously the COMEX wants to ensure confidence in the system.
Right.
They said, okay, you see this huge supply of gold come in. And I'm talking, you had 10 million of ounces total in the COMEX system that's registered and eligible. And again, 95% of that was actually eligible, meaning not available for delivery.
Right.
And all of a sudden that 10 million surged to 40 million in a
Hmm.
few months. So you're talking about a huge increase.
Right.
And not only that, but the amount that's registered exploded, right? You're
Mm-hmm.
talking under a million to 20 million is now
Wow.
sitting there. Now, I think personally, I think that was a confidence game, right? I think that was
Right.
to say, hey, don't worry, we've got a backstop, we've got plenty of gold, nothing to see here,
Mm-hmm.
nothing to worry about. And I think people were fine with that for a bit, but I think that theory is being tested right now. And like I said, and it's happening across all the vaults. They're all losing money, or sorry, metal. And it's really accelerated. And so that's the one that I'm really tracking very closely. But it does kind of mix in with the delivery volume, right? Because people are taking delivery, they take the warrant, and then they take that money out of the vault.
Right.
And so you're right. I think there is a vault run going on, and people want to see how deep, that metal really is. And, I think while the futures and the paper contracts are all trading and you're seeing gold kind of fluctuate around the 1750, 1800 level, I think the smart money is saying, I will take your 1780 gold and I will take it right into my pocket.
Yeah.
Uh, and I think we're seeing that unfold right now.
So you think there's kind of a psychology thing that's going on in certain segments?
Yeah, I think people are, I wouldn't say losing faith, but you wouldn't see this kind of activity, right? I
Yeah.
mean, it's not easy to take delivery, right? You got to
Right.
find a place to put it. They already handle that for you, pay a small storage fee. It's fine. So it's like taking your money out of the bank. You don't
Yeah.
want to do that. You
Right.
don't have a vault in your house. Why are you taking it out of the banking system? You're only really doing that if you're starting to question whether they have everything they say they have.
It's interesting because I feel like the kind of mainstream narrative on gold right now is nobody really wants gold, and it's kind of it's it didn't provide an inflation hedge because it was being brought down, and yet you're saying apparently a lot of people want to have gold. There's almost a disconnect there from what you get from kind of the narrative and what you're seeing in the data, right?
Absolutely. And I think that's really what it is, right? On the surface, everything looks fine. It's like people are the price gets smashed when the Fed comes out with their hawkish talk because everybody's like, no reason to hold gold. But I think the smart money is looking at what's going on and saying, sure, it may not be imminent, but this is unsustainable. And so I'm going to take mine out and I'm going to keep it with me. And what I like to see with this acceleration is I think it's showing that people think that maybe we're getting a little bit closer. Um, right. Because I think it goes back to what I was saying with the Fed and the debt. And that's how I think all of this is interrelated. And that's why, I try and look at all this data because it's like they have a short runway. They
Mm.
need this to be fast. And it's like, sure, 0% inflation last month, not true, right?
Right.
Your prices are still going up. My prices are still going up.
Right.
And the sticky prices are the ones that are starting to go up. And
Hmm.
you've talked before and the suppression of things like how fast rents are going up and the way that they've completely changed how shelter is calculated in the CPI and hedonics and substitution. It's all driven to try and give that confidence that like the Fed can keep rates low because
Right.
that's where they need to get back to. And
Everything's fine. Nothing to see here. It's all
right,
good. We got this.
exactly,
Yeah.
exactly. Everything is fine. Inflation's under control, which we know that inflation was never running at 2%. It was running much
Right.
hotter.
Of course.
Um, but the mainstream takes that. But again, I think that what you're seeing in the gold market underneath the surface with the physical metal is some astute investors that are looking at the situation and saying, if for any reason this inflation fight drags on, things are going to get ugly.
Yeah.
And I think that's where you really want gold and silver, and you want it in your possession, not just
Yeah.
sitting in a vault somewhere that has your name on it.
Right. What's your thoughts on the so-called Reddit squeeze that they tried to pull off in the silver market back in, I guess what? It's last year or the year before. Time runs together. But
Yeah, it was February of
but they did manage
2000.
to push the price up.
Yeah, and you know what? Honestly, I'm a little disappointed because I think it had legs, right?
Mhm.
And if you do the right vehicles, right, like SLV has a lot of language in that prospectus that gives them the flexibility to not necessarily have all the metal that they need, immediately on hand and all that kind of stuff. Where, and sorry, just to give you a little backstory. So Wall Street Bets is where that originally took place,
Right.
right? And somebody had wrote a really good article that said, "Hey, there's not enough silver out there.
Hmm.
This is something that you squeeze, and you were squeezing the big banks, right? You start taking this metal out and start making them show their cards, you're going to see a run." And the moderators at Wall Street Bets actually kind of snuffed it out. They wanted to focus on GameStop at the time, and they said that's where our attention should be. That's where we want to point our resources. So any posts that were coming up on silver were squashed. And
Interesting.
so a new forum popped up called Wall Street Silver.
Hmm.
And they've got about 200,000 members. I post a lot of stuff up there. And that community has been growing. And while it's not in the headlines, I do think that short squeeze is actually still kind of going on behind the scenes.
Interesting.
Now, we talked about gold and the amount of gold leaving the vaults, but with silver, it's slightly different. What's happening is the amount of registered is shrinking, and
Hmm.
it's shrinking a lot. So since the start of the silver squeeze that you mentioned, the amount of registered is down about 60%. So that's a lot. I
Yeah, it's
mean,
a
you're
lot.
talking about draining a vault that's down 60%. You repeat that for another year, and all of a sudden, there's no registered silver available for delivery.
Hmm.
Um, Now, I don't want to get into too much of it here, but there's another really good poster on Wall Street Silver called "Ditch the Deep State." So always appreciate that
Yeah.
name handle. And he's kind of got a theory, and he did a recording that talks about how there could have been a silent default on silver
Hmm.
back in February. And I had published an article about this where kind of overnight the data actually changed, and it changed to such a significant degree it would have been 12 standard deviations
Hmm.
above normal. And basically what happened was there was a huge amount of delivery volume. And then the next day they basically republished the numbers, and it was half
Huh.
the amount of numbers. Now, again, this guy has a really good analysis on it. Great article. I can send you some links and you can put it in the show notes.
Yeah, I'd like to do that.
But yeah, I think he does a really good job explaining what happened and some theories behind it.
So what's the difference, just for people who might not know the nuances? You mentioned SLV, and then you have GLD in there. So you have these ETFs. What's the difference between an ETF and a future? Or is there a difference?
Yeah, absolutely. ETF is something that you can buy. I mean, you can buy futures contracts on Schwab and E-Trade and stuff, but an ETF is a share of a fund
Right.
that basically has the metal sitting behind it, right? And even the ETFs, there's some nuances between them. So for example, at Wall Street Silver, they say, obviously you want to take delivery, but if you can't take delivery, PSLV is actually a much better vehicle than SLV, because
Hmm.
PSLV has their own vault and they actually take the money out of the system, the metal out of the system, right? And
Right.
to put it in their own vault, where SLV kind of, it can be in that COMEX system sitting in eligible category, right? But either way, the ETF is easier to trade. It's very liquid. It trades throughout the day. Futures contracts are more expensive. You're using a lot more leverage, right?
Right.
Buying an ETF is like buying a stock,
Hmm.
right? You don't need to use leverage. You can go in. If every day you want to buy $10 of silver, you can do it with PSLV and buy a share every single day.
Yeah.
A futures contract is going to give you far more exposure. It's far riskier. And again, you're talking about 5,000 ounces of silver that you're controlling with each contract.
Right. Right. Okay. That's a really good explanation, because I talk a lot about the difference between physical and an ETF. And there's certainly reasons to hold both, either or both, depending on what your goals are. But I think for a lot of people, all those nuances get lost. So I think it's important to make those things clear. I know there's one gold ETF. I can't remember the name of it, but you can actually exchange your shares for the physical metal. If you have enough to get an ounce, you can get an ounce of gold out of your. So there's different ways they set those up.
Yep, absolutely. Yeah, and the ETF is kind of a good way. What I'll do is I'll buy slowly into an ETF, like every month, put money into PSLV,
Hmm.
and then when I feel like I've got 500 ounces or so, I might convert that into an order. Right, that brings down my premiums. It's just a way to dollar cost average in. So it's a good way to in my mind, convert dollars into an ETF that then becomes actual metal that you own.
Right. Right. So any other thoughts on the COMEX before we kind of wrap up and tie this in a knot?
Yeah, I mean, I'll say one thing. People talk a lot about price manipulation and price suppression. Now,
That's something that's interesting to me, because um, I do a podcast every week, and almost every week somebody will say in the comments, "Well, what about the manipulation?" It's like,
yeah,
I don't have the bandwidth to. I'm a journalist by training, so for me, I need to have evidence before I'm going to tell a story, and just asserting something to me doesn't make it true necessarily. But then on the other hand, there's a part of me that's like, well, it's certainly not out of the realm of possibility that there's all this manipulation going on. So that's something that's interesting to me, and I don't know how to answer the question, so I just ignore it.
yeah. So, I mean, people feel very strongly about this, and
Oh
so
yeah.
you do want to tread carefully. But I do have some views, and I'm with you. I want to see the data first before I speculate. Right now, with that being said, I think there's two types of suppression that we should quickly cover. One is the short term, and the other is kind of the long term. Now, in
Right.
the short term, I mean, JP Morgan just
Right.
had a couple guys get indicted on the fact
Yeah.
that they've been spoofing metal. Now, that being said, I don't necessarily think it's always to the downside, right? I mean, sometimes you'll see, and that's the thing, is these guys know where these technical traders are talking about. We talked
Hmm.
about the chart patterns and, 1800 a hard level, right? And you could spoof down to hit it below 1800 to hit all those sell orders, right? And then create the snowball down. But
Right.
you can do it on the way up as
Yeah.
well, right? Because you might have a lot of shorts that need to cover. And I think that's actually what happened. We saw gold go all the way down below 1700,
Hmm.
and then it rallied back up because I
Right.
think I think all of a sudden there were too many people on the short side, and that's what the commitment of traders report showed, and so the rebound I think looked imminent there, but anyway, so people cry whenever it gets pulled down, but they don't recognize that the same activity is happening on the way up.
Right. It's the same thing with, like, when gas prices go up, it's the evil gasoline companies that are gouging prices, but then when gas prices go way down, nobody complains about that. It's kind of the same
Right.
dynamic.
Right. Exactly. And again, I mean, this is happening for sure. I mean, again, JP Morgan just had a
Right.
court case on it. You can read about it. I mean, they were spoofing metal, where basically they come in with a bunch of contracts to try and hit a certain level that they know will trigger other orders, and then they cover afterwards.
Right. And they can do that because a lot of this stuff is computer generated. So you have a set price when boom, the computer's going to sell. It's not like you have to have somebody sitting there by the computer
Right.
to put all of this into action. So it is pretty easy to, but I guess the important thing to understand about that is they might change the price of gold today, but it's not going to change the price of gold next month. What they did today is not going to have ramifications way down the road.
Yeah, I mean, it can, if you think about kind of what's happened over the past 2 years, where, the price has kind of been capped and, pushed back down. And I think that has hurt some of the psychology of gold. But you're right. I mean, over the long term, I mean, anybody who thinks there's price suppression has been watching a chart, because it was $300 or around $300 in 2000. And now we're sitting, 6 times higher, right? If there was price suppression, they're doing a really bad job of it. But that being said, I do think there is natural price suppression in the system. And by that, I mean, the COMEX and the futures market makes it a fractional reserve system,
right?
Meaning they can meet demand with paper instantaneously. They can create as much paper gold as they want to meet demand.
Right.
And so when you think about it, all these people who want gold, if they're sitting there with paper and they get the same price exposure, they're fine. And so it's a fractional reserve system that I think has dramatically hurt price discovery in gold, because you've got a technically unlimited supply of paper.
It's like fiat money.
Exactly. And that's why, again, going back to watching the metal leaving the vault, to me, seeing that is so important, because I think it's people saying, okay, I like your paper gold, but I would rather have my physical. So anyway, bottom line is, I don't know that you need to actually try and suppress, because I think the system by itself does that, right?
Okay.
And the COMEX can actually do things with CME where if gold gets too long and it gets too high, they can just raise margin requirements. Right. So let's say margin requirements are $6,500, and I'm really long gold and I've only got a little bit to cover, and they raise margin requirements to 10,000. I have to now liquidate or post margin. I have two options.
Right.
So if I need to post margin, then I've got to come up with all that cash. If I got to start liquidating, I start selling, all of a sudden it starts triggering all those sell orders, the snowball happens, right? So, I don't think it needs to be conspiratorial behind closed doors. I mean, it's pretty much out there, right? I mean, it's in the open. It's the way the system is designed. Personally, I struggle with conspiracies because I don't give the government and really a lot of people enough credit to be able to pull them off. I've seen how big organizations function and the dysfunction within them.
Right. And nobody can keep a secret.
Yeah, exactly. So anyway, so that's just my thoughts on the matter, but I just wanted to mention that before we wrap up here.
Yeah, that's really that's really good. We're definitely of the same mind. You know a little bit more about it than I do, but something I want to talk about in the show tomorrow, because I think I'm finally going to have some time to talk about something besides the Fed. So since people keep bringing it up, I feel like I need to address it. So that kind of helps me put some thoughts in order. So I would definitely like to, in the relatively near future, have you back on, because there's some other things I'd like to talk about. You mentioned the COTS report. I'd like to talk about that, and managed money, and kind of how all of that impacts the system. But on the other hand, I don't want people to get bored. So so maybe we could wrap it up now, but maybe in a few weeks we can have you back on and kind of go over some more of this stuff, because I think it's really important. As I said, it's really adding a lot of value to what we're doing over at SchiffGold, just trying to give people a kind of a holistic view of the gold and silver marketplace, obviously outside of the mainstream, because you're going to get a completely different view if you go read Reuters or Bloomberg or watch CNBC or whatever. But I'm still amused by this retail sales thing, that all of a sudden they just now discovered that changing prices impact retail sales numbers. They ignored that for months, but now all of a sudden that's a thing. So it's kind of funny. But anything you want to say to wrap up?
No, again, just, thank you for having me. I appreciate the opportunity to come on. Happy to come on again. Just let me know when.
Yeah. All right. We'll do it. I appreciate the work you're doing. And again, folks, you can check out what Tony's writing over at SchiffGold.com/news. And there's a heading for it, and I can't remember what it is, but I can put the heading in the show notes page, and you can actually pull up all of this data analysis and kind of see how things are playing out. So look forward to having what's coming up.
Yeah.
All right.
Yeah. Thanks, Mike. Appreciate it.